A wise person has said that in investing, what you don't know can hurt you. Take the time to explore the hidden corners and delve into the nuances. It's the key to avoid financial pitfalls. Hello and welcome to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey into the world of financial shenanigans. In our previous episodes, we have discussed the world of financial shenanigan and delved into their motivations. Today, we are laying the groundwork for becoming a more informed and cautious investor by checking a few basic areas that you should look before investing into a company. Whether you are just starting out or looking to refine your investment strategy, these fundamental considerations are a key to making financial decisions. In the second segment, I am going to discuss with you the specific financial shenanigan area revenue. So let's dive in. In the first segment, as I told you, I am going to discuss with you some valuable points that you should look before even putting a rupee into a company. The first thing is looking for checks and balances. When I say checks and balances, I do not mean the safety measures to make sure the money records are accurate and honest. But here it means that the power should not be concentrated into the hands of a few. In a good company, each member of a board should be freely able to criticize and disagree on any resolution. But sadly, when financial shenanigan happens, in most cases it is because of no presence of checks and balances among management. In such cases, there is a dictatorial leader who run all the things. An example of such leadership can be Albert Dunlop of Sunbeam Corporation, a manufacturer of various household appliances and consumer products. The second thing that you should look for is cutthroat executives. What does that mean? It means those executives who want success regardless of the cost. Senior management of most of the listed companies yearn to report positive news and impressive financial results that satisfy investors and drive the share price higher. Unfortunately, not all companies are ethical when it comes to reporting proper results. Do you know about Joe Nashio? Well, he was the CEO of Quest Communications. He gave a speech to his team and said that the most important thing is to quote unquote meet our numbers. His that philosophy resulted in a good amount of profits, but later he was sued by SEC, accusing of orchestrating a sweeping $3 billion accounting fraud from 1999 to 2002. Nacho was later convicted and sentenced to almost 6 years in federal prison. Now let's move to the third point. Imagine encountering managers who turn even the simplest achievements into grand showcases of their greatness. Let's call them promo prodigies. These are the leaders who exhibit excessive pride and self satisfaction, overshadowing their team's efforts. While it's important to celebrate achievements, it's equally vital to strike a balance between self promotion and fostering a collaborative and humble work environment. Take the example of Royal Ahold, which later emerged as one of the largest frauds in Europe. It always boasted about its streak on its earning call with investors. Quote unquote, this is the 13th consecutive year in which our net earnings have grown significantly. Ahold has always met or exceeded expectations during this 13-year period, and we intend to continue to do so. Now let's discuss two small pointers that we should look at. The first one is looking for the qualifications of the board. Is the member on the board qualified to be there, and are they performing their work properly? And the second one is that the members of the board are providing their service in the committee that suit their technical skills or not. Always keep these 2 points in mind. Now let's move to the second segment of this episode and discuss specific area of shenanigan. In the world of investing, revenues are like the heartbeat of company. Investors listen closely to this financial pulse because it reveals the company's ability to generate income. Strong revenue growth signals a healthy business that's capturing market share and meeting the consumer demand. It's the starting point for evaluating a company's financial health and potential for future success. But investors often overlook the fact that revenues, although significant, can be manipulated easily or can be inflated easily. In this segment, we will explore the potential pitfalls of relying solely on revenue figures and delve into the importance of a more nuanced approach of evaluating a company's financial performance. In this segment, I'm going to discuss with you, along with a few examples, a part of different financial shenanigans that can happen to manipulate revenue. Some companies really want to show big sale numbers at the end of a quarter. They might do tricky things to make sales from the next time look like they happen now. It's like moving the pieces on a board to make their sales look better. At Computer Associates, executive stretched the last month of the quarter to nearly 35 days, even backdating and making fake sale contracts. They did this to show more sale growth than was real, fooling their auditors and investors. The reason? Huge bonuses and stock options. They had a plan. They would give them lots of extra shares if the share price went high and stayed that way. In 1988, they hit the jackpot, giving bonuses worth over $1 billion. But their achievement weren't that special. The stock price went up in a time when most stocks were going up, and they cheated to get those results. Other companies did similar tricks like changing the quarter's end date to make their sales look better. Sunbeam and Peregrine did this too, keeping their books open even after the quarter was done. So, when companies play this time and numbers, it's important to be cautious and not just believe everything they say. Always look closely and think properly. Companies sometimes use percentage of completion accounting to record revenue from long-term construction contracts. Management calculate revenue based on the percentage of the completion of the project during a period. Aggressive assumptions can lead to inflated revenue, and companies that are ineligible for this method sometimes misuse it. A red flag is a large increase in unbilled revenues when sales and billed receivables grow moderately. Raytheon Company, a defense contractor, also used this method incorrectly, recording revenue based on incorrect estimates of cost and unit sales, leading to inflated revenue and earnings until they had to correct it later. Now imagine a company that leases out equipment like copiers to customers. This company needs to decide when to recognize the revenue from these leases. Sometimes they might use lower interest rates to make it seem like they are earning more revenue upfront. This is like getting paid for the whole lease even when the customer will pay over time. In India, revenue recognition for lessors depends on the nature of lease. For operating lease, lessors generally recognize lease income on a straight line basis over the lease term. For finance lease, they recognize interest income on the lease receivable and any profit or loss related to the underlying asset. Xerox inflated their revenue and earning by using lower interest rates for capital leases. Wait, what are capital leases? Don't worry, they are same as finance lease. This made future lease payments of Xerox look like upfront revenue. They also moved revenue from lease charges earlier than it should have been. Sometimes companies adopt acceptable methodologies that were intended for other companies or for other industries just to recognize revenue earlier than normal period. And the same thing was done by Enron. Before I go on telling more about these shenanigans, let us summarize what we have studied yet. Some companies try to make their sale look bigger by using tricky ways to change when and how they count their money. It's like pretending you finished the game level even when you didn't. They might guess how much money they will get and say it's true even if it's not. Sometimes they even say that they got all the money now, even if they will get it later. Some companies also use rules that weren't meant for them to get more money early. It's important to be honest and follow the right rules, just like we do when we play games. Now, let's go on and discuss three more shenanigans under this segment. Companies such as Sunbeam use a bill and hold arrangement to recognize revenue before shipping the product to customer, to inflate the revenue by shipping the goods to third party warehouses while recording the revenue. This is allowed if the customer requests it and the main beneficiary is the customer. For example, if a buyer lacks storage space, they might ask the seller to hold the purchased goods until they need. If the seller initiates this arrangement, it's a red flag of early revenue recognition. Companies such as Krispy Kreme shipped equipment to company owned trailers rather than the actual franchisees and yet recorded the revenue. This tactic is misleading as revenue recognition should occur when the product reaches the customer. Companies like Kendall Square Research and Sterling Homex recognize the revenue before the customer secured necessary funding, although the revenue should be deferred until the final acceptance by the customer or the return period lapses. So let's conclude today's discussion. Today, we have covered essential aspects to consider before investing. We discussed the importance of checks and balances in company leadership and the risk of cutthroat executives who prioritize success at any cost. We also explored the impact of promo prodigies who overshadow their teams. Moving on, we highlighted the significance of board qualifications and suitable committee roles. Transitioning to revenue manipulation, we delved into the tactics like recording revenue too soon, which involve companies bending the rule to make their sales look better. We touched on the tricks involving bill and hold arrangements, misleading shipping tactics, and recognizing revenue before the funding is secured. By being aware of these tactics and clues, you can become a more informed and cautious investor, ensuring sound financial decisions. Thank you for listening to this episode. In the next episode, we shall continue the discussion on revenue shenanigans. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.